Welcome to the option trading course of Growing Wealth. In this option trading video series, the following will be the course of content that we will be going through. In this video, we will be touching on the basics of the call option. And in subsequent videos, you will then learn what is a put option, how does option pricing works, and how does the option Greeks control the pricing of options. And then we will go through how to set up your trading platform if you are using the Thinkorswim software from TD Ameritrade or the trading platform from Interactive Brokers. And lastly, we'll move into the basics and advanced trading strategies with examples. Before learning options, your foundations and understanding of how stocks work should already be solid. Otherwise, please go through our technical analysis course as well as the stock trading course to obtain your stock mastery first before embarking on your journey for option trading. Options are a form of financial instrument that is derived from an underlying asset, and for the most part of our content, we will be using stocks. When trading stocks, there are two main things to consider. The first one being the stock price, and the second one being the trend. That is it going up or down? Goes up, you long, goes down, you short. But have you ever held on to a sideways moving stock for like so long, generating no profit for you, and even locks up your capital for other profitable trades? Frustrating, isn't it? Well, in options, you can profit even when the stock is trading sideways. And this is because of an additional component to it, and that is the time. If you have watched our risk management strategy video, you have learned that no matter what your capital size is, the maximum number of trades that you can take at any one point of time is relatively small, due to the large capital requirement per trade. But on the other hand, when you trade options, you can achieve similar risk to reward level with just a fraction of the capital. And this is largely also because that options is a highly leveraged tool. So please do not go off trading options on your own after watching this video. If you do not know what you are doing, you will blow up your account. There is a lot to cover about options, as an option contract is further split into two types, the call side and the put side. And for each of the calls and put, you can either long them, which is to buy them, or you can also short them. In other words, short selling. In order to help you understand all of these with ease, let us start with the call side of things. So what are options? First of all, options are contracts. Therefore, the call option is a contract that allows the buyer to have the right to purchase 100 shares of the underlying stock at the specific strike price at or before the expiration date. There is a lot of key information being condensed into a simple contract here. And when you buy options from your broker, the order is usually represented in this notation, which captures all the key information that we need to know. In this condensed line here, you are buying one contract. What contract? A call option contract. Now, a call option contract of what? Of the Apple stock, which is the underlying stock in this case. And this contract controls 100 shares of Apple. This contract has an expiry date that is dated on the 19th of June 2020. And the strike price of this contract is at $300 per share of Apple. The last piece of information is this at $10. This is the price of the call option contract that you are buying. And this price here is stated as per share. Since this contract controls 100 shares, you need to multiply this by 100, and that is the price that you will be paying for this contract. So which is $1,000. Now, what does all of this mean? You can think of buying call option contracts like paying a deposit for something that you want to buy in the future. For example, you want to buy a house, but you do not have the cash on hand to purchase the entire house right now. So you pay a deposit to show your commitment and owns the right to buy the house after you have saved up enough money in the future. Similarly, in this case, you want to buy Apple at $300 per share. So you bought this contract and paid a deposit of $1,000. These contracts then allow you up till the 19th of June 2020 to get ready the $30,000 to buy your 100 shares of Apple at $300 each. So as a call buyer, the deposit that you paid for the contract is also known as the premium. Anytime when you are ready to buy the shares, you can exercise the call option. pay up $30,000 and then get your 100 shares. One thing to note is that the $1,000, which is the premium that's used to buy the contract, is lost once you exercise the contract. Now you should know by now that stock prices are never stationary. From the time you bought the option till the time of expiry, the price of Apple is likely to be different. But you have locked in your purchase price at $300 per share. What this means is that if Apple goes above $300, you would have profited the difference. On the other hand, if the price of Apple decreases to below $300, you would have lost. At maximum, you will only lose the premium that you have paid. That is the $1,000 for the contract. And if the stock price of Apple drops too much, let's say it is now at 280 for example, you just let your call option go to waste and expire worthless, losing all the premium that you have paid. I believe no one will exercise the call option to buy Apple at $300 when the stock price is at 280, am I right? What we described just now was a little vague. So let's examine in detail how does the profit and loss of a call option buyer looks like. As a call option buyer, your max loss will always be the premium paid, and in this case it is the $1,000. At expiration, you would have realized your max loss when the price of the underlying stock is equal or less than your strike price. So recall that your strike price is at $300. So $300 is over here, and your max loss occurs when the stock price falls below $300. Now, what is your break-even point? Your break-even point is not at $300, alright, but at $310. To get this number, simply add the premium paid to the strike price of the contract. So $300 is the strike price, and the premium paid is $10 per share. So in total, you get the break-even price to be at $310. And lastly, your maximum profit is unlimited at expiration if the stock price of Apple can continue to rise. With this, I hope you realize now the power of options. When you buy a call option, you are basically controlling 100 shares of the underlying stock, in this case Apple, for just $1,000. A tiny fraction of the capital required if you were to buy 100 shares of Apple at $30,000, am I right? And for every dollar that Apple rises above the break-even price, you profit dollar for dollar. This is what I mean when I said earlier that options are highly leveraged and you only need a fraction of the capital required as compared to when trading stocks. When you purchase a call option, you are bullish on the stock. You think that the stock price will rise in the future and then go ahead to purchase the call option. So as a call option buyer, you have to pay the premium and you only profit when the stock price rises. You lose if the stock price falls or stays sideways. And this is how the P&L chart of a call option buyer looks like. Unlimited profit, limited loss. Sounds attractive, right? Now what about a call option seller? Remember that in order to buy a contract, there must be a seller on the other side. When you sell a call option contract, what it means for you is that you are now obligated to sell the 100 shares of the underlying stock at the specific strike price at or before the expiration date. So anytime before the expiration date and your buyer says, hey, sell me the shares now, no matter what, you will have to hand over the 100 shares at the strike price. No questions asked. In that case, what's the benefit of being a call option seller? The seller profits from collecting the premium paid by the buyer. As a seller, you collect these $1,000 in premium, and naturally you profit when the buyer doesn't exercise his option. This happens when the stock price falls below the strike price, and at expiration, you get to keep all the premium. On the opposite scenario, if the stock price rises above the strike price of the contract, then you would have incurred a loss. And this will be how the P&L chart of a call option seller looks like. As a seller, your maximum profit is limited. This is realized when the underlying stock price is lower than or equal to the strike price of the contract. And in this case, the strike price of the contract is at $300. And so the max profit will only be realized if Apple can stay at 300 or drops below 300 by the time of expiration. Your break-even point will be the same at 310. And this again is calculated by adding the strike price of the contract to the premium collected, which is $10 per share. And that's how you get the break-even price to be at 310. As a seller, you are faced with an unlimited max loss. This is because if the stock price of Apple suddenly shoots up to $400 or even $1,000, for example, and the buyer exercises the option, you have to sell the 100 shares to the buyer at $300 per share. So if you compare the difference between a call option buyer and seller, this is how it would look like. As a buyer, you have the right to purchase the 100 shares of the underlying stock stated in the contract, and as a seller, you're obligated to sell the shares whenever the buyer wants it. So as a buyer, you have to pay the premium for the contract, and as a seller, you collect it. So from a buyer standpoint, he profits when the stock price rises and lose if the stock price falls or stays the same. And on the other hand, the seller profit when the stock price falls or stays the same and lose if the stock price rises. And this is how the profit and loss or the P&L chart of the buyer and seller looks like. The buyer is faced with a capped loss and an unlimited gain, while the seller is faced with a capped gain and an unlimited loss. To simplify it further, you buy a call option for the stock if you are bullish on it and think that the stock prices will go above the strike price. And you sell a call option when you have a neutral view, thinking that the stock won't have much movement during the period, or if you have a bearish view that the stock price will fall. That's all for this video on the introduction to call options. Please do not attempt to buy and sell call options after watching this video, because there's still a lot more to consider that we have not went through yet. I would like to stress again that options is a highly leveraged instrument and that will blow your account if you do not know what you are doing. So after having covered what is a call option, in the next video we will look at what is a put option. And that completes the basics of options. Moving on, we will then go through the more advanced stuff about options as seen in the list here. Make sure to like this video and subscribe to the channel so that you will know when the next video is up. Thank you so much for watching, and I look forward to seeing you in the next video.